Step back from the 1-minute chart, because while retail traders are panicking about a paper dip, the smartest money in the room is quietly building a fortress at $80, not because of technicals, not because of sentiment, but because they have done the math. February 11th, 2026. Silver is fighting between $72 and $80, and institutional buyers are defending that line like their survival depends on it. Why? Because they know something the mainstream financial media will never tell you. They know what happens when China controls 70% of the world's refined silver, and they know what happens when COMEX runs out of deliverable metal. The question isn't whether silver explodes from here. The question is whether you secured your position before the fortress gates closed. Welcome to Black Silver, where we don't insult your intelligence with hype. If you have built a business, if you understand balance sheets, if you recognize when markets are lying to you, then you already know that serious analysis doesn't come with rocket emojis and crash predictions. Do us a favor, hit that subscribe button. Not because we need the algorithm, but because strategic economic intelligence should reach the people who actually make decisions. And drop a comment below. Tell us where you're watching from. New York? London? Singapore? Dubai? Because what's happening in the silver market right now, it's happening differently in every geography. And the smartest investors are watching all the battlefields, not just the COMEX screen. Now, let's talk about why $80 has become the Maginot Line of the precious metals market, February 11th, 2026. Gold is holding steady at $5,050 per ounce. Silver is caught in a violent tug of war between $72 and $80. And while the financial media is talking about volatility, about corrections, about healthy pullbacks, the institutional analysts are watching something far more significant. They are watching a defensive perimeter being constructed in real time. Physical silver buyers have drawn a line at $80, and they are defending that line with a level of aggression that tells a very different story than what the chart technicians are selling. This isn't about support levels. This isn't about moving averages or Fibonacci retracements. This is about structural supply collapse and the small window of opportunity that remains before the market reprices permanently. The question every serious investor needs to answer is simple. Who is buying physical silver at these levels? And why are they treating $80 like the last reasonable entry point before the gates close? Let's start with the evidence. The Shanghai Gold Exchange is reporting premiums that should not exist in a functioning market. In a normal commodity market, when prices spike in one geography, arbitrage traders immediately buy in the cheaper market and sell in the expensive market. The price gap closes within hours. That is how commodities work. But January 2026 broke that mechanism. While COMEX paper silver was trading at $73, physical silver in Dubai was changing hands at $127 per ounce. That is a 70% price gap, 70%. And it is not closing. Why? Because the arbitrage mechanism requires one critical ingredient, the ability to move physical metal from west to east. And that ingredient no longer exists. The buyers defending $80 are not retail traders watching TikTok videos. They are family offices in Singapore securing tonnage for wealth preservation. They are industrial manufacturers in Germany locking in supply for solar panel production lines that cannot function without silver. They are sovereign wealth funds that understand what happens when a commodity market bifurcates into paper and physical, and the paper price becomes irrelevant. These buyers are not checking the RSI indicator. They are checking vault inventories. They are checking mint production backlogs. They are checking Shanghai premium data. And what they are seeing is a supply chain that is already broken, with the fractures widening every single week. The United States Mint reported in late January that Silver Eagle production is running 6 weeks behind demand. 6 weeks. The Royal Canadian Mint has suspended taking new bulk orders for silver maple leafs until March. Dealers in London are quoting delivery times of 4 to 8 weeks for wholesale orders above 1,000 ounces. 4 to 8 weeks for a commodity that used to be available for next-day delivery. This is not a temporary supply disruption. This is the new normal, and the institutional buyers know it. Here is what separates the $80 defenders from the retail panic sellers. The retail trader looks at the COMEX screen, sees silver drop from 78 to 72, and assumes the rally is over. He sells. He takes his small profit or cuts his loss. He moves on to the next trade. The institutional buyer looks at the same drop and sees something entirely different. He sees COMEX inventory falling below 100 million ounces for the first time in a decade. He sees open interest in the futures market that exceeds deliverable physical inventory by a ratio of 5 to 1. He sees China exporting 70% less refined silver than it did 6 months ago. And he calculates the replacement cost, not the current price, the replacement cost. Because that is the number that matters when you are trying to secure 10,000 ounces or 50,000 ounces or 500,000 ounces for an industrial application that cannot substitute silver for anything else. The replacement cost calculation is simple. If physical silver in Dubai is trading at $127, and if export restrictions are preventing metal from flowing west to east, and if COMEX inventory continues depleting at the current rate, then $80 is not expensive. $80 is the last bargain. The defenders are not buying silver because they think it will go up. They are buying silver because they have done the math on what happens when the paper market runs out of deliverable metal. They have studied what happened in the nickel market in 2022 when the London Metal Exchange had to halt trading because short sellers could not deliver physical nickel. They have studied what happened in the palladium market when Russian supply was cut off and prices doubled in 3 months. They understand that when a critical industrial commodity enters a supply deficit, the price does not move in percentages, it moves in multiples, and the floor at $80 exists for one reason, because the ceiling calculation, the real ceiling, starts at 150 minimum. But why? Why is the supply chain broken? And why can it not be fixed? The answer lies in what China did in January 2026, and that is where the story gets dangerous. There is a number that changes everything, 70%. That is the percentage of global refined silver supply that flows through Chinese processing facilities. Not mined in China, refined in China. And on January 14th, 2026, the Chinese Ministry of Commerce announced export licensing requirements for refined silver products. The mainstream financial media barely covered it. A 3-paragraph Reuters article, a footnote in the Wall Street Journal's commodities section, but the institutional commodity traders understood immediately what had just happened. China had just weaponized the global silver supply chain, and there is no backup plan. Let's be very clear about what refined silver means. Silver comes out of the ground mixed with other metals: copper, lead, zinc, gold. It has to be processed. It has to be refined to 99.9% purity before it can be used in solar panels, in electronics, in medical devices, in military applications. The refining infrastructure is not something you build in 6 months. It takes years, billions of dollars in capital investment, environmental permits, technical expertise, and 70% of that infrastructure, 70% of the world's refining capacity, is located in China. Mexico mines silver. Peru mines silver. Australia mines silver. But they ship the raw ore to China for refining, and then China ships the refined product back to the world. That was the system. Past tense. Here's what the January 14th announcement actually did. It did not ban silver exports. That would have been too obvious, too aggressive. Instead, it created a licensing system. Chinese refiners now need government approval to export refined silver. And the approval process, according to industry sources, is taking between 6 and 12 weeks, 6 to 12 weeks, for a commodity that industrial manufacturers need on 30-day supply contracts. Do the math. If you are a German solar panel manufacturer and your silver supply is suddenly delayed by 8 weeks, your entire production line shuts down. If you are a Japanese electronics company and your silver paste shipment is stuck in Chinese customs waiting for export approval, your factory goes idle. The licensing system is not a ban. It is something far more sophisticated. It is a controlled choke point, and it is working exactly as designed. The price bifurcation that began in January is not a temporary anomaly. It is the new market structure. COMEX paper silver trades at $73 because the futures market is still pretending that supply and demand are in balance. Physical silver in Dubai trades at $127 because the physical market knows the truth. There is not enough deliverable metal, and the gap cannot close because the arbitrage mechanism is broken. Normally, when Dubai silver is trading $54 higher than New York silver, arbitrage traders would buy in New York, ship the metal to Dubai, and pocket the difference. But they cannot ship the metal because 70% of refined silver flows through China, and China is not approving export licenses fast enough to balance the market. The Western warehouses are depleting. The Eastern buyers are paying premiums, and the spread is widening, not narrowing. The institutional buyers defending $80 understand something that retail traders do not. They understand that this is not a temporary supply disruption. This is a permanent structural shift. China is not going to reverse the licensing requirement. Why would they? They control the choke point. They can allocate refined silver to domestic industries first, to strategic partners second, and to Western buyers last. And there is nothing the London Metal Exchange or COMEX can do about it. You cannot force a sovereign nation to export a strategic commodity. You cannot sanction China without destroying your own supply chain. You cannot build replacement refining capacity in 18 months. The leverage is entirely one-sided. And the institutional analysts have already run the scenario models. If China maintains current export licensing delays, If Western inventory continues depleting at January's rate, if industrial demand remains constant, then the physical silver market goes into structural deficit by April 2026, not a temporary shortage, a structural deficit, where demand exceeds available supply, and no amount of price increase can immediately fix it. Because you cannot refine silver faster than the infrastructure allows, you cannot ship metal that does not exist, and you cannot substitute silver in 90% of its industrial applications. This is why $80 has become the defensive perimeter. The institutional buyers are not speculating on future price increases. They are securing physical allocation before the allocation window closes. They are treating silver like a strategic resource, not a tradable commodity, because they have studied the Chinese export data. They have modeled the inventory depletion curves. They have calculated the timeline to deficit. And they know that once COMEX runs out of deliverable metal, once the paper market breaks from physical reality completely, the price will not move in $10 increments. It will gap. And when it gaps, there will be no $80 silver available. There will only be whatever the seller demands, silver. But how does COMEX maintain the $73 fiction while physical trades at $127? That is where the manipulation becomes visible. And that is where the trap gets dangerous. There is a magic trick happening in plain sight, and most traders cannot see it because they are watching the wrong hand. While physical silver buyers are paying $127 per ounce in Dubai, COMEX is reporting a spot price of $73. That is a $54 difference in the same metal on the same day. How is this possible? The answer is not complicated, it is just uncomfortable. Because once you understand the mechanism, you realize that the paper market is not designed to discover price. It is designed to control price, and control only works until it doesn't. Let's start with what COMEX actually is. The Chicago Mercantile Exchange Silver Futures Market is not a physical delivery market. Less than 2% of contracts ever result in actual metal-changing hands. 98% of traders are using COMEX for speculation, for hedging, for leveraged bets on price direction. They have no intention of taking delivery. They roll their contracts forward. They close positions before expiration. They trade paper, not metal. And that system works perfectly, as long as the 2% who do demand delivery can actually get their silver. But what happens when inventory falls below the level needed to satisfy delivery demands? What happens when open interest exceeds available metal by 5 to 1? COMEX has a playbook for that, and they are running it right now. January 21st, 2026, COMEX announces a 15% increase in initial margin requirements for silver futures. The official reason? Increased volatility. The real reason? Force leveraged speculators out of long positions. Here's how it works. If a trader is holding 10 silver contracts with $50,000 in margin, and COMEX increases margin requirements by 15%, that trader now needs $57,500 to hold the same position. If he doesn't have the extra capital, his broker liquidates his position. Automatically, no warning, no mercy. And when hundreds of leveraged long positions get liquidated simultaneously, the price drops, not because fundamentals changed, not because supply increased, but because forced selling created downward pressure. The retail trader watching his screen sees silver drop from 78 to 72, and he assumes the rally is over. He sells, he confirms the price drop, he becomes part of the cascade. But the institutional buyers see something different. They see COMEX using margin manipulation to suppress paper price, while physical premiums in Asia continue climbing. They see the divergence widening, and they understand what that means. The paper market is losing control. So, February 4th, 2026, COMEX raises margin requirements again. Another 12%, 2 margin hikes in 2 weeks. The financial media calls it prudent risk management. The commodity analysts call it what it is, desperation. Because here is the problem COMEX cannot solve. Every time they raise margins and force speculators out, they temporarily suppress the paper price, but they do not create more physical silver. The Shanghai premium does not disappear. The Dubai buyers do not stop bidding $127. The German industrial manufacturers do not suddenly find alternative supply. All COMEX accomplishes is widening the gap between paper fiction and physical reality, and the wider that gap gets, the more obvious the manipulation becomes. The institutional defenders at $80 are watching the COMEX inventory reports like battlefield intelligence, because those reports tell the real story. January 1st, 2026, COMEX registered silver inventory stood at 108 million ounces. February 1st, 2026, 92 million ounces, that is 16 million ounces withdrawn in 1 month. At that depletion rate, COMEX runs out of deliverable silver by June. Not might run out, runs out. Mathematics. And the open interest sitting on those contracts right now represents 460 million ounces of silver, 460 million ounces of paper claims, against 92 million ounces of physical metal. That is a 5-to-1 leverage ratio. In a normal market, that is manageable, because 98% of contracts settle in cash. But what happens when 3% demand delivery instead of 2%? What happens when the Chinese export restrictions prevent replacement inventory from arriving? What happens when industrial buyers stop trusting COMEX settlement and demand physical allocation instead? The system breaks, and everyone knows it. This is why the institutional buyers are ignoring COMEX price signals. They are not trading paper contracts. They are securing physical tons, and they understand the timeline. The paper market can maintain the $73 fiction for maybe another 60 days, maybe 90 if COMEX keeps manipulating margins. But the physical market is already trading at 127, and that gap is not closable, because you cannot print physical silver the way you print paper contracts. You cannot margin call a supply deficit. You cannot force liquidate a refinery that does not exist. The institutional calculation is brutally simple. Buy physical at $80 now, or try to buy physical at $150 in April when COMEX admits they cannot deliver. The floor at 80 exists because sophisticated buyers have done the replacement cost math. They know what silver costs when you actually need tons, not contracts. They know what happens when paper and physical decouple permanently. And they know that the COMEX game ends the same way every manipulated market ends, with a short squeeze that destroys everyone who believed the fiction. But the real danger is not the paper market collapsing. The real danger is what happens to the financial system when silver is repriced. Because if silver has to revalue to 150 or 200 or higher, then gold's revaluation becomes unavoidable. And that is where the central banks lose control completely. There is a number that keeps central bankers awake at night: $12,595. That is the price gold must reach, not to make investors rich, but to save the monetary system from collapse. And if gold must revalue to 12,000, then silver's revaluation is not a possibility. It is mathematical certainty. Let's talk about Daniel Oliver. He runs Merkin Capital. And unlike the financial television personalities who sell hope and fear in 30-second sound bites, Oliver studies the historical mechanics of currency collapse. He does not predict. He calculates. And his calculation is simple. When a fiat currency system reaches terminal debt levels, when confidence evaporates, when inflation becomes uncontrollable, the central bank has one option left: restore credibility by backing liabilities with hard assets, not 100% backing. That is a fantasy. But history shows that to stop hyperinflation, to prevent total monetary collapse, central banks must back between 33 and 50% of their balance sheet with gold. 33 to 50%, not because they want to, because mathematics forces them to. Look at the Federal Reserve's balance sheet today. Trillions of dollars in printed money, trillions in reverse repo liabilities, trillions in bank reserves that must be paid 5% interest, while the Fed earns only 2% on its Treasury holdings. The Fed is currently losing $245 billion per year. $245 billion. They are insolvent. And Kevin Warsh, the man Trump just nominated to run the Federal Reserve, cannot fix this with interest rate policy. If he raises rates to kill inflation, the Fed's losses explode and the Treasury goes bankrupt, paying interest on $36 trillion in national debt. If he cuts rates to save the Treasury, inflation goes vertical and the bond market collapses. He is trapped. There is only one exit door: revaluation. Here's the math that CNBC will not show you. If the Federal Reserve is forced to back 33% of its liabilities with gold, and if you divide total Fed liabilities by the gold ounces held in Fort Knox, gold must be revalued to $8,395 per ounce. If 50% backing is required, which history suggests is more likely, gold goes to $12,595. This is not speculation. This is division. Total liabilities divided by gold ounces equals 12,000. And if gold revalues to 12,000, what happens to silver? The historical monetary ratio between gold and silver has ranged from 15-to-1 to 50-to-1. 15-to-1 was the Roman standard. 50-to-1 was the modern commodities average. But here is what makes 2026 different from every previous monetary reset. Silver is no longer just a monetary metal. It is a critical industrial resource. Solar panels cannot function without silver. Electric vehicles require silver in batteries and charging infrastructure. 5G networks require silver in every connection point. Military defense systems require silver in radar, in missiles, in electronic warfare equipment. You cannot substitute silver in 90% of these applications. You cannot print silver the way you print currency. and you cannot mine silver fast enough to meet exponential industrial demand. This creates a dual demand crisis that has never existed in human history. Monetary demand plus industrial demand competing for the same finite supply. Let's run the conservative calculation. If gold revalues to $10,000 per ounce, and if silver maintains even a 40-to-1 ratio, silver must trade at $250 per ounce. 250, not as a speculative target, as mathematical equilibrium. But the institutional buyers defending $80 are not using the 40-to-1 ratio. They are using replacement cost analysis if physical silver is already trading at 127 in Dubai, and if Chinese export restrictions continue, and if COMEX inventory depletes to zero by June, then the question is not whether silver reaches 250. The question is whether it stops at 250. This is why sovereign wealth funds are buying physical tons at $80. This is why industrial manufacturers are securing multi-year supply contracts at premiums. This is why family offices are treating silver like a strategic allocation, not a commodity trade. They are not betting on a rally. They are positioning ahead of a revaluation that the system will be forced to accept. Because when the paper market breaks and when COMEX admits it cannot deliver, when the Fed announces gold revaluation to recapitalize the balance sheet, silver will not move in $10 increments. It will gap from 80 to 150 overnight, from 150 to 200 in a week, and there will be no going back. The floor at $80 is not technical support. It is not a Fibonacci level. It is not a moving average. The floor at 80 exists because institutional analysts have calculated the ceiling, and the ceiling is not 100. It is not 150. The ceiling is wherever the mathematics of revaluation forces it to be. 250 is the conservative estimate. 300 is the mid-range scenario. And anything above that happens when panic buying begins, when retail investors finally understand what institutional buyers already know, that silver is not just undervalued. It is structurally mispriced by a factor of 3 to 1, minimum. The defenders at $80 are not protecting a price level. They are securing allocation before the window closes. They are buying physical metal before the paper market implodes. They are positioning ahead of a monetary reset that will redefine asset prices for the next 50 years. The second phase has begun. The question is not whether you believe the analysis. The question is whether you understand the timeline, because the fortress at $80 will not hold forever, and when it breaks upward, violently and permanently.